In August 2025, it is being said that UK government borrowing costs are rising to 5.6% per annum, and as a consequence, Rachel Reeves is going to face a financial crisis. And there are a lot of people who are rubbing their hands with glee. And for once, I'm going to say Rachel Reeves is on the right side of this story, and the financial markets have got it wrong. Let's be clear as to why that is the case. First of all, UK government bonds are not carrying interest rates of 5.6% at present. The vast majority were issued at rates somewhat lower than that, and the rate of interest paid on a UK government bond is fixed throughout its life. And as a consequence, the 5.6% is what people are earning on government bonds in the second-hand bond market. But that is not the price that is being paid by the UK government. And if the UK government was wise, and I admit there is a very big if in that last statement, with that word doing a great deal of work, but if it was wise, then it wouldn't be issuing bonds right now, because why on earth would it choose to pay interest of 5.6% for maybe years to come if it were to issue bonds now, when it could instead borrow from the Bank of England at present and wait for interest rates to come down, as I am quite sure is going to happen. So let me do a little bit of explanation. Right now, UK stock markets are at record highs. If you want to see the chart, there it is. At the time that we're recording this video, the market is at around 9,280 and has been over 9,300. And these are levels it has never reached before. The point is, investors are pouring money into the FTSE 100 at present, following in the footsteps of what is happening in the USA, where AI is creating a massive stock market hike, and they're selling government bonds to buy shares. And the simple fact is that when people sell government bonds, their price falls, and so the yield rises. Let me explain that, because it seems that very few people understand the very simple mathematics involved in this process, but which is fundamental to understanding why this supposed interest rate crisis is arising. Suppose that a few years ago, 5 years ago maybe, the UK government issued a 30-year bond at £100, and they promised to pay £4 of interest a year on that bond. In other words, the fixed interest rate on the issue price was 4%. And that interest will be paid whatever the market does until the bond comes up for redemption, which would, on the basis of this example, be in 25 years' time. And that's it. As far as the government is concerned, nothing will ever change. But now suppose that the people who own that bond decide they want to put all their money into the stock market because they think that there is money to be made there, and as a consequence, they're all trying to sell the bonds they own. If everybody tries to sell the bonds they own, guess what happens? The price falls. And let's suppose that the price of that £100 bond now falls to £80 in the second-hand market. What goes on then? Well, as far as the government is concerned, nothing, because it still pays £4 a year in interest. But for the person who buys that bond at a price of £80, the interest rate now looks like 5%. They paid £80 for the bond, they get £4 of interest, and so the yield has apparently gone up from 4% to 5%, even though, as far as the government is concerned, nothing has happened. And now let's suppose, as I am expecting, that the stock market crashes. It fell by nearly 50% between the beginning of 2000 and late 2002 when the dot-com crash happened, and I'm expecting there to be a fall of broadly similar proportions as a consequence of the AI bubble bursting. It would be quite possible in that case for the price of that government bond to increase to £120 as people pull their money out of the stock market, and put it back into bonds. Let's just look at what that does to the bond rate. The same £4 is paid, but now somebody buying a bond would have paid £120 for it, and therefore the yield would fall to 3.3%. The yield has fallen as the price has risen, but the point is that markets move and not government risk. And that's exactly what we're seeing at present. The only reason why the UK government appears to be paying interest rates of 5.6% or more per annum at present is because there is this massive speculative bubble going on inside the FTSE 100 and inside global stock markets, which are pushing up the prices of shares, dragging money out of bond markets, and as a consequence, pushing up the apparent interest rate paid on government bonds, even though the actual sum which departs the government bank account will, in most cases, not change at all. Bond yields are being altered as a consequence of the spike in speculation in share prices, but not because of anything to do with the change in the risk of lending to the government, whatever the media might like to say. So, this current 5.6% yield that we're seeing in bond markets is very likely to be temporary. The moment that we see stock markets begin to fall, and everybody is beginning to expect that to happen, from the New York Times to the Financial Times to me and quite a lot of other people as well, there is going to be a financial collapse. The government should, as a consequence, quite simply not be issuing bonds at this moment. There is no reason to issue bonds at 5.6% when they could instead borrow from the Bank of England for the time being and wait until the rate has fallen before issuing bonds again, if that's what they wish to do. And the government should also be telling the Bank of England to stop its quantitative tightening process at present, because that is selling bonds right now at an undervalue and crystallising losses for the government, which are wholly unnecessary. All this market noise should be ignored by a wise Chancellor. A wise Chancellor would be sitting back at the moment. A wise Chancellor would be withholding bond issues at present. A wise Chancellor would realise everything that I have said is true. Again, I have to say the words "a wise Chancellor" are doing a lot of work in the last few sentences that I have said, because maybe we haven't got a wise Chancellor and maybe they are therefore going to carry on issuing bonds. But the reality is, if Rachel Reeves had any sense, she would be sitting out this peak in interest rates on the bond markets, because they're going to fall. It's time that she used all the financial instruments available to her. It's time that she told the bond markets, "I'm not interested in the games that you play." It's time she sent a message to the London Stock Exchange, "You're fueling a bubble and I'm not going to play part of that game." It's time she actually acted maturely and recognized that she is in control. She doesn't need to borrow now. She shouldn't be borrowing now. She should be sitting out these interest rates, and she should be issuing new bonds, if that's what she wishes to do, when the crash comes, because at that point, everyone is going to want them. Thanks for watching this video. If you've enjoyed it, please do click the like and subscribe buttons, because they do genuinely help us spread the word on YouTube. As importantly, could you have a look at the section below this video where it says "More"? And there you'll find a link to my blog. And if you follow that for the specific link to the blog entry related to this video, you'll find a transcript of this video and lots of other related material, plus a ChatGPT prompt that you could use to write a letter to your MP on the contents of this video, which will turn you into a campaigner, which will be a great thing to do. Finally, if you do appreciate the work we're doing, can you think about giving us a donation? If you'd like to do so, there's a link below, or you can find one on my blog where there's a Ko-fi button saying "Please buy me a coffee." Thanks a lot, and we'll see you again soon.